Why do banks go bankrupt when sometimes they publish these enormous profits that give the impression that the bank is incredibly solid? We need to look at the balance sheet of a bank and understand what it is comprised of, and certainly that it is significantly different from the balance sheet of a normal business. When we look at the assets of a bank, we have profitable assets. Those profitable assets are usually our loans to businesses, to families, etc. Furthermore, they have some investments in companies or businesses or private equity, venture capital, etc. Additionally, there are contingent assets that are used to maintain the normal course of business, so physical money, etc. And then there's the unprofitable assets, or at least those tangible assets that are not redeemable or that are going to generate a profit every month. No, like for example the building, etc. of the bank. Okay, so those are the assets, profitable assets, and those other assets that comprise the left side of the balance sheet. Let's look at the liabilities. In the liabilities, what we have is obviously the deposits of the bank. The deposits that we leave in a bank are not left there, they're invested, and therefore it is a liability for the bank because they need to repay them when needed. Additionally, the bank has capital that provided by shareholders, etc., and also it has obviously those reserves that have been accumulated from profits that have not been distributed. So that's the liability side of the balance sheet. Now, why does a bank go bankrupt? Well, to start with, it can be because it loses deposits. Then it has to liquidate assets to make do for those deposits and to pay for them. And therefore, what it has to do is to sell the most liquid and the most safe asset of what they own, and that tends to make it more difficult as the process of deposit loss increases. That's why it's so important to contain the risk of loss of deposits. Additionally, the other reason why a bank can go bankrupt is because the asset side loses value very quickly. For example, non-performing loans rise dramatically, the investments and the value of the loans goes down dramatically because of a different valuation in the market of real estate or businesses or different activities, different valuations. That can go down very, very quickly and make it very difficult for the bank to address that financial hole in the balance sheet. So what happened in the case of the recent bankruptcies is that the safest and less volatile asset that these banks had, treasuries, sovereign bonds, was actually as volatile and as risky as other assets that they owned because they were hugely elevated in valuation because of monetary policy. So when the Federal Reserve makes the sovereign bond extremely expensive, or other central banks make the sovereign bond hugely expensive by purchasing at any price sovereign bonds, what ends up happening is that banks treasure in their asset base these bonds that are not the ones that provide stability, low volatility, and high liquidity, but ones that are as risky and as volatile as equities, as other risky loans or risky investments. So when the bubble bursts, what happens is that the value of the safest asset collapses rapidly alongside that of the investments in the more aggressive part of the balance sheet, in technology, venture capital, etc. Then the financial gap in the balance sheet is impossible to address by increasing liquidity. So deposit losses are generating a big problem, while valuation and non-realized losses of the asset base are shrinking the asset base as well. So what ends up happening is that the capital of the bank is wiped out very rapidly by that double force: loss of deposits, destruction of the valuation of the asset base. That's how a bank goes bankrupt. And in this particular case, it wasn't because they took very aggressive measures of lending to very risky activities. It was fundamentally because the allegedly safest and less volatile part of the asset base, sovereign bonds, became as risky and as volatile as the riskiest part of their loans and investments. And as monetary policy went further into massive purchases of sovereign bonds, making them more expensive and therefore more volatile, and also introducing negative rates, the policy of central banks generated the problem that has burst rapidly in banks right now. How? Negative rates make the profitable asset base less profitable, more risky. Banks take further and further higher risk to generate lower returns. Second, the sovereign bond that gives stability to the asset base doesn't give stability. It actually generates enormous unrealized losses. So you thought easy money was a good idea. Easy and cheap money destroys the financial sector.